Okay, what I'd like to do today is discuss anything you've got with respect to your use of Excel in the assignment that I believe you submit today. Look at some other questions you might have about sources of growth or anything we talked about with respect to IRR, MIRR, etc. I want to introduce something referred to as a profit index to you. And then we're going to do another board assignment, taking some different numbers, some different scenarios, and seeing how they play out, and then discuss issues you had and getting to them, etc. Fair enough? Okay, all right. So with that, what questions might you have with respect to the Excel assignment that you've been working up on the financial statement? Wow, cool, really? Does anybody not get it submitted yet? Okay, I know we talked about that, right? Yeah. Okay, so after we go through the board assignment in a little bit, I'm going to go ahead and bring up one of the spreadsheets, maybe even for the same company you guys are working on. You're working on Farm Hill Group, right? Yeah. Okay, I'll bring up the Farm Hill Group spreadsheets so you can see where this first assignment ends up leading you. Okay, I want you to see what the final outcome of this is, so you kind of have an appreciation, and it'll help you understand some of the linkages you're going to need to make as you go through some of the future week assignments. All right. Any questions on MIRR, IRR, thinking about payback, decision criteria, setting up the multi-columnar valuation structure that we've talked about now a few times? Yeah, please.
How can you calculate on the present value of the discounted cash flows without just like discounting back each cash flow individually and then like adding them all up? Like, is there a shortcut to do it on the calculator?
Ask me that one more time, please.
Like finding the present value of the discounted cash flows instead of just like finding each one individually and then adding them all up. Is there a shortcut to do it on the calculator?
Yes. So if you know each of the cash flows, and you know the discount rate, and you are willing to synthesize a cash flow for the final year of your explicit period that equals that year's cash flow, plus the then present value of all the future cash flows, you can put them into the cash flow function CF0, CF1, CF2, and have it tell you present value. We've actually done that a number of times.
Not just net present value, but present value?
Net present value. So when you are trying to use non-constant cash flows, which you are, especially if you're synthesizing for the last year of the explicit period, some value that equals that year's cash flow and a value that represents, as of that point in time, all future cash flows, so that's our continuation term, right? Then you have a non-constant series of cash flows, right? You do not use the PV function key on the top row. You use the NPV function key on the second row, which I believe is the second key from the right, and it's in red. So you would press the red secondary key and then NPV. Now your argument might be, well, wait a minute, what if we're trying to find a PV, which is the estimated value, right? And you had no cost at time 0 or any other time, such that you have nothing to net it out against. It doesn't discriminate. The NPV function and the PV function, the way that the calculator uses it for non-constant cash flows, are the same function. Okay, it just is not netting it out against a price. Please.
Will we ever have to find present value with the cost?
No, because that is, when you have a cost, now it's net present value. Yeah. But the only difference is that you've introduced a cost. Otherwise, it's the exact same thing. So a present value has a cost of 0 at time 0, right? And that's the estimated value of the future stream of cash flows without you having invested anything. The net present value introduces the cost function, which is what you are expecting to invest, and then lets you have an IRR, MIRR, all those kinds of things, profit index. Okay. What else? Wow. Okay, so we got 3, 6. Oh, this is perfect today. Okay, so we're moving right to the boards then. And let's have the 3 of you work together. The first group and the third group will be doing the evaluation from the perspective of the firm. The second group and the fourth group will do the evaluation from the perspective of the would-be investor. Okay? So several times we've gone through and done valuations, present value or net present value with our calculator's cash flow function, right? And I believe a couple of times I've shown you the multi-column structure, but I don't think I've caused you to necessarily have to use it yet, right? What challenges did it present to you to have to construct it in the multi-column structure? Please.
I think the hardest thing for me to remember to do was add like the exponent for yours when you're just getting the present value of your future cash flows.
Getting the right exponent. Okay? What else? Obviously, it's not necessary to do this, right? In fact, in a single cell of your spreadsheet, you could have done everything. You could have done the free cash flow calculation for each of the years. You could have done the present value of the free cash flow calculation for each of the years. You could have let them all add up. You could have done a continuing value divided by 1 plus R to T and it being part of your summation terms there. You could have done all of it in one cell, right? What's the virtue then of using this multi-column structure where we used, I'll use this one as the example, what, 6, 16, we probably used a good 22 or 23 cells to show what we could have just done in a cell. Right?
For me, it's visually helpful to see it kind of, for example, like I was able to track where I was at number-wise by seeing it increasing and decreasing, so I think that helps visually seeing it being added up equals this and then something.
Okay, okay, Bobby?
Yeah, like kind of like you said, and like you said earlier, you can see how it relates to each other. Like you walked up and said it didn't make sense that since we were dividing by a number greater than 1, the present value of our future cash flows was higher than our free cash flow.
Yeah, and that doesn't make sense, does it? So it lets you immediately see some problems that might be brewing, okay? Zach?
I think using it as a model, especially if you're doing forecasting or something like that, where you have access to change certain cash flows or certain variables, when you have it all laid out like this, you can say something special for this year or something that we can anticipate for a certain year, and you could use it like that.
Okay, I agree with that. There's another issue when you're doing things in either small groups and or communicating them to any size group. I'm going to use the example you guys were experiencing. And I think I'm right about this, and correct me if I'm not. So Mikkel had the spreadsheet out, and he was accurately representing and everything in the spreadsheet. He was calculating the free cash flows, putting everything in cells that made perfect sense to you, right, Mikkel?
Yeah.
Garrett? did his construction make sense to you, and could you immediately know what each one of his numbers represented?
Roughly, he just never labels anything.
But why is that a problem? Mickle knew exactly what was in that cell and what it meant. Why is that a problem?
Doesn't make sense to anyone outside of him.
Well, it may, it just didn't make sense to you. There might be a million Mickle, well, let's be honest about it.
There's only one.
Hallelujah, there's only one, okay? Yeah, so it could have made sense to a million people, but making sense to the person right next to you? Probably not, right? And Sherry's standing back there. I'm not getting involved in this. I'm not gonna argue with these guys. I'm gonna let them piss it out here for a while. We're gonna come with the right number, and I'm gonna be cool, calm, and collected, and it's okay. Right? Isn't that what you were doing, Sherry?
No.
I think it is. Or something not all that far from it. Actually, Sherry was being very active. She knew that the two of them were gonna get it. We discuss things in a common convention so that we can all know what we're discussing, and we can point to a number, and when I point to this number, I don't have to tell you what it means without a label right next to it, because you know the construction. And if you're not already very familiar with construction, all you do is look at the column heading, that's it, right? So those are some of the values of doing it this way. You're right, all of those are meaningful. Now, at the end of the day, I don't know that you need to come up with a value that way. But I think when you're learning to come up with these, it's not only a good idea to have a common convention, but a convention where it lays it out so nicely that you can immediately see problems. For example, Zach was doubting significantly, seriously, looking for the number now, Zach, where is
It's
it?
the 22 at the bottom there.
Which one?
On the third one.
The blue one, and it's at the very bottom. Are you talking about that 18 at year 20?
Yeah, he was doubting the validity of this number because it is so different than the prior number. Well, it's not that different.
Yeah, it's from 2.6.
Well, 21 to 22 is not much of a difference.
We have the
No.
timestamp in
That's the
front. It's
continuous.
year
Yeah,
26.
yeah,
Zero
the
points.
I'm sorry,
timestamp
when
is-
there's 7 people trying to say one thing and they're not doing it in sync, I hear 17 things. Zach,
It's
You-
the 2.634 to the 18.37.
They have a timestamp, like 21, 22.
I don't see those numbers. Where are those numbers?
So they're labeling 17, 18, 19, 20, 21,
Got
22.
it, got it. Okay, thank you. I might have had this number a little bit separate from this one. And I don't know that I would have used a decimal point to separate them. I might have used a space.
You told us to.
I
to not to take
know,
out
I know.
four, So.
It's all good now, but you get my point?
Maybe
Okay,
a parenthesis.
so yeah, so he went from 2.6 to 18.3 and wondered, he questioned the veracity of this number, right? Because it was such a big move. And he was right to question it. But without using a structure somewhat like this, it's hard to see it, to question it. When you're much better at these things and had a lot more experience and practice, you don't even need to do that because you now know your methodology is sound. When you're trying to figure out your methodology and whether or not it's sound, it's good to see everything, and as it turns out, nicely labeled. Okay? Now, that said. So let's look at this for a minute. So this first set of values and the third set of values are the same scenario. Okay, we're using the same cash flows. But in this first set, we used, I believe, 7% as the discount rate. So that was WAC, so it's the standpoint of the firm. And here we used, what was it, 25% as the discount rate. So we're valuing it from the standpoint of the investor. We ended up, when we did that, with a value of 32.6 for this firm, compared to a value of 300.32 for the firm. Virtually a 10 times difference, right? Explain that. The numbers are right. Explain to me why we have such a big difference.
An investor's gonna wanna use a different rate because he doesn't wanna pay 300, he wants to pay 32.
Okay, I agree. So an investor uses, the investor wants to pay a smaller number. And when you say the investor uses a different rate, what rate are we talking about?
Personalized investor rate. Yeah.
Okay, so the discount rate.
Yeah.
Okay, Cole?
Guessing.
Okay, all right. If the WAC, the weighted average cost of capital for this company, was really 7%, and if that WAC was calculated with market values, such that it is a true representation of the opportunity cost of the capital that has gone into the formation of that company in today's market construction. And that company has a risk component to it, right? It has all the makeup of risk, reward, varying cash flows, varying financial conditions, etc. If that number is 7%, how does an investor justify a 25% discount rate? How can I come in and look at Garrett's company, which has a 7% cost of capital, and his had a different one, but if it has a 7% cost of capital, how can I come in and only invest money? I'm not putting in time and talent, right? I'm simply an investor. I'm just doing passive money investment. How can I think I'm going to get 25% when the opportunity cost for the capital in that company with that risk profile, etc., is 7%? How do I do it?
Is that according to like what I think I can get elsewhere?
Well, you might be saying, I can get 25% elsewhere as an investor. And if that really is your opportunity cost of capital, A, it means you've been experiencing it. It's not aspirational, right? It's not, I hope I can get it, but I know I can. And when we know things, it's because we've observed them. Haven't just surmised, synthesized hope. We've observed them. So if you as an investor can get 25%, and this is a company, the risk profile, and remember risk and reward are not terribly far apart, right? There's similar issues but looking from different vantage points. Why would you put your 25% money into a 7% company?
Because you think that the firm isn't operating at maximum efficiency?
You think you know something that the current management doesn't know, and you're now going to communicate that to them. But I think now you went beyond just investing your money, didn't you? You invested some of your intellectual capital to help them, your time and talent. Okay. If it's just your money, can you realistically have that kind of a difference in your discount rates? You might like it. You might want to think you can. How realistic is it? Brigham, the hand went up and then down.
I was just gonna say, I feel like it's not that realistic. I think that the only way you can argue is that like a surge of capital could help the case, but at the end of the day, it's not realistic to assume that it would jump unless.
Well, in this case, you're not talking about investing new capital into the existing
you're
company.
getting your
You're
money
talking
back?
about acquiring the company.
I don't think you can.
And yet, how many investors out there are certain they can beat the markets?
100%.
100% of us, right? Otherwise,
You wouldn't be an investor.
almost certainly. I promise, well, investors, I don't know, it's 100%. I mean, as an investor, I'm happy to get a market return. Happy to get it, right? A trader, on the other hand, almost certainly thinks they can beat markets, right? What's the difference between an investor and a trader? Bobby?
An investor can invest in like a bunch of different properties, or invest in anything, and a trader deals with stocks. Is that?
That's not necessarily true. I might be a trader and I might trade real estate or trade bonds. Zach?
In my mind, when I think of trader, I think more short term, and investor is you're investing for longevity.
Exactly. So Warren Buffett, investor or trader? Investor. Buffett buys things and he wants them to be passed on to his progeny, right? Whereas you got, and I don't know any of the big names of the traders right now. Some of you might. They come and go like anything. But a really successful trader today probably has positions that are only going to be invested today. And so a day trader liquidates everything by the end of the day. Okay, every day.
This is kind of just a side note, but this summer at my internship, they said that out of all their traders, they have, I think it was like a huge number, right? They have one person who beats the algorithm now. That's it. They said only one person can beat the algorithm, which is kind of sad, but.
Right. Well, and to me, traders, when people talk about the investment markets as being gambling, to me, traders are gambling. To me. They don't think that necessarily, but maybe they do. If you listen to some of the books on these things and look at how the methodologies, Some of them use a risk construction that's very similar to if you were gambling. Okay? An investor, though, puts money in for the long term and maybe does or doesn't have any influence in the company. If you think you can get a significantly better return than the discount rate of the company, which is their WACC, and if it's really a market WACC, then you're saying one of a few things. Either you believe you know some things that the company doesn't, you know, you believe their sales are going to be higher than they think they're going to be, you believe they're going to experience some lower input costs than they think they're going to, so you either think you know something they don't know about their future, or you're saying that you have some particular skills, relationships, etc., that when applied to the company will improve the condition. Or you believe you're going to now take this asset and connect it to another one, get some scale economies, or something, right? You can't sit here and think passive and passive and believe that you're going to outperform the current cost of capital for the firm if you're only investing your time. Okay? So in this case, we have an extraordinary disparity of almost 10 times, 300 versus 32. Okay? Now the other two, we ended up here where I think that this was a 14% discount rate, which is the company's cost of capital, right? And then same numbers, but at an 18% discount rate. Is that disparity, 14 and 18%, reasonable, realistic, or still off base?
It's very realistic.
Okay? Bobby thinks it's good. Does anybody agree or disagree? Cole? You're nodding your head. You think it's good? Okay. 4% off of 14 is what percent? 4 divided by 14, what is that? 17 calculators sitting in front of me.
40.
4 divided by 14.
28%.
So in this case, you think a 28% spread over and above the company's discount rate is reasonable?
I think if you just amplify everything with more money, then it becomes less reasonable.
Oh. So here, this is interesting. As an investor, I might not immediately think that's unreasonable. It's only 4-point spread, 14 and 18, not that far apart, right? But when you say it's 28% higher, think of the difference, the percentage differences in the bid price of something you might find in the markets versus the ask price. So I would think that if we were looking at a share of stock, common stock, that last traded at $32 a share, I'm going to suppose that the bid before that trading agreement took place at 32, the bid was probably 31 7/8, so an eighth of a point off, give or take. And the ask might have been 32 1/8, give or take, right? If these are in the active markets. You're rarely going to find a spread of more than about 1/4 of a point. That's not a 28% difference, is it? 1/4 of a point on 32, so what's 0.25 divided by 32? What is it?
Point. I'm not going to put it down.
It's a
0.78.
0.78
So
spread.
0.7% spread.
It's a big difference.
Yeah, so 0.7% spread is not much of a spread. 28% spread is a pretty serious spread. However, I would say that most investors, even prudent investors, believe that they're going to get some performance greater than what we're looking at based upon the company's cost of capital, if they were even looking at the company's cost of capital. How many investors do you suppose look at the company's cost of capital when they're making investment decisions? I'm talking about stock and bond investors in the markets, the liquid markets, NYSE, NASDAQ, etc. If it's 1% of them, I'd be shocked, right? So think about that which sets up the difference between bid and ask. Is it the expected cash flows? I think scenario 1 and 3 use the same cash flows. Scenario 2 and 4 use the same cash flows. It's not the expected cash flows. Is it the long-term growth rate? It's the discount rate, right, Zach? If we all had perfect information and we all shared perfect information, which is an assumption of competitive markets, right? Would we then all know what the long-term growth rate would be, and would we all think it's the same thing? Yeah, if we all shared the same information. We would all agree on what the cash flows are going to be. It's the discount rate. So when you see bid and ask, it's an issue of discount rate. So Kira, when you go to buy that car, you're going to buy Alex's car, his used car. He wants $10,000 for it, you want to pay $8,000 for it. You guys settle it at 9. Okay? Did you impute a discount rate when you decided to offer him $8,000? Alex, did you impute one when you decided to ask for 10?
No.
Of course not. Did we? Did we really? Did we not? Think about this for a minute. Alex, why were you willing to sell the car at $9,000? You wanted 10 for it. When you said you're willing to sell it to Kira for 9, what are you communicating?
You need the money now.
Or you were pricing it above its actual value and you're willing to settle for its actual value.
I think both of those are plausible. I think most specifically, you're saying her $9,000 is more valuable to you than your old car at that moment, right? I don't know if he needs the money or just wants it, or just, or maybe doesn't need the car. But your $9,000 is more valuable to you than your old car, right? And what are you saying, Kira, when you agree to pay $9,000 for it?
That car's worth $9,000 to me?
Or it's worth at least $9,000 to you. The car might be slightly more valuable to you than your $9,000. When we personally put a value on something, know it or not, we are running it through a filter that includes our personal discount rate. How money changes value for us. Even when it's utility, like we get out of a car. So I think most of us would not expect a car to be an investment, right? The only kind of cars that any of us typically buy that would be really an investment might be a collectible, a classic automobile, something you buy because you're not going to be driving it around and depleting its value every moment it's on the road. But do you think you're going to keep, have some fun with, and then sell later on because it's an investable? It's that 63 Chevy, or rather Corvette, or whatever, right? I guess it's a Chevy. So think about this issue of bid and ask with discount rates. Hopefully having to put together these structures and going through this scenario today compared to the one we went through the other day, which in some respects use the same functions, right? But in others, you had to figure out free cash flow. From an equation you already knew pretty well, but it took you a few minutes to go from those line items to figure out what free cash flow was going to be, right? If you did that in Excel, as most of you are doing, then it becomes pretty quick, doesn't it? Let me pull up these spreadsheets real quick and show you what's going on here. Because this is going to give you an idea as to where we go with the Excel assignments. And we said Farm Hill, right?
Yeah.
Okay. I'm not going to make this small enough so you can actually, or big enough so you can actually read everything. Just going to bring up some sheets that you'll recognize. Why do we not have, oh, we have video mute, that's why. Okay. Now it's Okay. Here, and I'm not using Farm Hill here because the Farm Hill I have on the server at the moment didn't give us the numbers that I was looking at or looking for. So what I brought up obviously is your financial statement, right? Or a variation of it, and all of the different ratios and such we might come up with. You guys don't have this on yours, I don't believe, because that's unique to this particular case for Leland Industries. So that's the first one you've developed. You're getting ready to develop another one. And the other one's going to look something like this. And I'll make it big enough so you can see a few things. Which is a little bit more elaborate than the sheets you guys are just working off of, but only a little bit. In which we've got our base year, we've got some forecast years, we've got some base year revenues. We create some ratios that you guys weren't using. Those were implied inside of the numbers you were given. But next week, I'm going to show you how we come up with these ratios and how the ratios influence the forecasts down here. Okay? So you didn't see it, but every one of the numbers you were working on for your forecast years were based on ratios from the base year with possibly some adjustments. And you'll see how to do that. So it gives us all these things, and I think I cut you guys off at this column, maybe it was even over here, but you can figure out all the rest of it. And then, so the next one you're going to deal with is putting together one of these, which just gives you your forecast. And then what you'll deal with next is once you have put together those forecasts, why this is not coming up. There it is. Then you can put down towards the bottom of your spreadsheet you can simply code from your model. I've got a different color representing each of several different valuation models. And it'll come down and give us our values, right down here at the bottom. The only inputs on this entire page are up here in the, those aren't even inputs, let's see. There are no original inputs on this in this entire sheet, right there. There are inputs here. Building ratios here, which we then use to drive all the values here. Okay? These are models. And so what you're building is this. Now, you're going to find it'll also build another sheet for you, which gives you the same forecast but with some adjustments. So you get to see the valuation, the forecast with adjustments and without. And then maybe you'll even build one that lets you do some NPV, MIRR, IRR selections as well. The only inputs were on that first worksheet. Is that a hand? Okay, all right. Okay, yeah, Graham.
When it comes to like in the actual workforce and doing this stuff, so to speak, do you feel like, I don't know how you had much experience with this, but is most of the situations where you're kind of given an Excel like this and it's already done and created the model and you're literally just replacing the inputs?
No.
Okay.
No.
Do you get what I'm saying with that? Like, I'm wondering if it's a different model for every...
Yeah, so different companies are going to use different models for different purposes. I think what you can expect is that when you have a position, if there's someone that has trained you, they probably will help you understand the models that they use, maybe give you a copy of them and help you understand how to use them, and then you're going to morph them for your own purposes. Or more likely, for the level of positions you're going to end up having someday, you'll be expected to build your own models.
For sure.
Okay, which is part of why we're going through this.
No,
it's helping you understand how to build models, right? I think a good example of that, and nobody in here is participating in this, but we have these two valuation teams right now that are preparing for the valuation challenge, and we have a professional evaluator who's a mentor for each of the two teams. And we were talking night before last, and the mentor uses a slightly different model construction than we do, and it took him a few moments to realize that his different model construction actually is simply the same metrics, just arranged differently on the page. But it was similar enough that everybody knew what the other was talking about. Yeah, Zach?
Would you advise us of creating templates for our models, like as we're in the workplace, when you make a model that works for this specific purpose, create a template to where you could plug in a few?
In fact, you guys have links to an Excel template page on one of my websites, and it's got a whole bunch of models on it, and they're exactly that. Yeah, they have firm names, they have values in them, but all you have to do is change the values for your firm, right? And you have to understand then how to manipulate. If you have 5 revenue lines for one company, only 1 revenue line for another, you got to think about how you deal with that. You have 17 expense lines for a company versus 12 for another. You got to think about how to morph your model to deal with that, right? But that's not that bad, as long as you know how the model is constructed.
Cool.
Okay? All right. I think that's where we are today. So I believe you have what assignment coming? Okay. I didn't print it out for you, I apologize. I'm now looking from my perspective, or my syllabus. Did one of you have my syllabus right in front of you? It was here, and it's now gone. Well, okay. Yeah, I'll give it back to you. Yeah, so next week, we're going to be dealing with these forecasting. Okay, so you start to figure out how to do revenue and expense forecasting, because I don't think we've touched those yet, right? Okay. And then today, the assignment is to create the next sheet within the Excel assignment, and you guys have just done some of that. In fact, some of you started to manufacture it on your own without knowing what you were expected to replicate. So you'll be creating a new tab in the worksheet that has your financial statement in it that you've now perfected, and that's going to be a tab that you'll see all the detail of it within the assignment, and you now know how to construct that. And then you have the CAP, M, and WAC problem set to begin to work on as well. Okay?
So nothing's due next time, but Wednesday's gonna be the
Let me look. So when you say next time, you mean?
Monday.
Yeah, nothing. In fact, we rarely have things due on Monday.
So
The
Wednesday-
only time we have anything due on Monday is the week of a test, when I'm trying to get it in before the test on Monday.
Okay.
So I can see what you guys are doing. Okay? Are we clear? We're clear. Thanks.